Hello all, I am John Matthew. Welcome to Stock Investing. Today we look at L&D Technology Services. Please do not confuse it with L&D, which is a different company. LTTS is a service provider for engineering, R&D and digitalization services. The business segments are as follows: transportation, industrial products, telecom and high-tech, plant engineering and medical devices. Most of its revenue comes from North America and Europe. The company pursues inorganic growth also and has acquired Graphene Semiconductors to improve its presence in the semiconductor domain and Essentia Technologies to make its presence felt in the OEM domain. All data in this presentation is based on the data available in Screener.in as on 12th April 2023 and the annual reports of the company for the respective years. Forensic accounting checks whether there are any discrepancies in the data provided by the company. Cash conversion ratio is the ability of the company to convert profits into cash. This is the ratio of cash flow from operations over operating profit. The average is 83%, which is significantly above the expected 70%. Trade receivables is the amount that the customers owe the company. Now all customers don't pay up as expected. These are classified as doubtful debts. As you can see, it is only around 2%. All companies carry cash in bank accounts, bonds, etc. and they get interest. If the interest is consistently low, say 1%, it may mean that the cash was available in the accounts for a small number of days. Here the average is around 4%, so this check is also fine. CWIP is capital work in progress. It is just 1%, which is fine for a services company. If auditor remuneration increases drastically, it may point to a lack of objectivity by the auditor. Here there is nothing unusual. Contingent liabilities are claims against the company, legal challenges, taxes which have been challenged, etc. In our case, it is only 3%, which is good. Hence, all 6 checks are fine. Before proceeding any further, I presume you know what are intrinsic value, free cash flow, and economic mode. If not, please watch my previous video on Deepak Nitrate. The link is in the description. We are using the discounted cash flow method to calculate the intrinsic value. Growth rate over 10 years assumed to be 17%. I will explain why we arrived at 17% towards the end. Discount rate or inflation 10%. You may wonder why 10%. India's current inflation is around 6 to 8%. But government calculates inflation based on the prices of a few items. So there are items whose prices increase by more than the inflation rate. I wanted to be conservative and use 10%. Terminal value, the ratio of enterprise value to free cash flow, which in this case is 44. Free cash flow is 851. Present value of the intrinsic value of the company after 10 years is 76,758. We take the present value to make it comparable to the enterprise value as of now. After applying the factor of safety, the difference is 23,901 crores, which means if you buy the company today, you are expected to make a gain of 64%. If you want to find the details of calculating intrinsic value using the DCF method, please watch my previous video on Deepak Nitrate. Now let us calculate the intrinsic value of the share using Ben Graham's revised formula. It comes to 4749 and after applying the factor of safety, it becomes 3799, which is a gain of 6%. Here we do the Peter Lynch check, but as you can see, it is coming to 2, which is higher than the maximum limit of 1.5. But I am not too much concerned about this because this financial year, the company's profit has grown by around 26%, which means the growth is much higher than 17%. So if we take say 26%, the ratio will be well below 1.5. Here we do the leverage check. As you can see, it has never exceeded 20%, which is the maximum debt to capital ratio. This is outstanding. Let us look at economic mode. Huge demand for techies, especially in the West. Let us take an example of Air India placing an order of around 200 aircrafts with Boeing. Now, to execute this project, Boeing will need a huge number of engineers, most of whom will become redundant once the project is over. Boeing cannot lay off people every time a project is over, so they will depend on engineering services companies like LTTS to meet the demand for skills. Whenever it is above normal, and there lies the demand. Moving on to the company. Outstanding technical capability with over 970 patents and a brand name as one of India's greatest engineering firms built over many decades. India produces millions of engineers every year, and the best among these can be recruited at a reasonable pay. I don't think any other country provides such a great combination of talent and cost. They have maintained excellent relationship with their clients, as the repeat business is over 90%. Look at their clients. The creme de la creme of the engineering R&D world is there. I would like to make a pointer to their ambitions. They have set up an R&D facility in Ontario, Canada, exclusively for a client which manufactures futuristic electric aircrafts. And guess the focus area. Vertical takeoff and landing speaks volumes about ambitions and engineering capability. Return on capital employed is consistently above 20%, which is the average expected, and this is excellent. Cash flow from operations has been increasing, and this is expected to increase even further this year. Also, company is investing in itself methodically. We should also look at challenges. A company, especially an Indian company, which has access to the same talent pool and excellent engineering skills, somebody like Tata Technologies can give a tough competition. Having said that, the market size is so huge that there is enough and more room for multiple players. Employees are the cash-generating resources in any services company. Retaining them, especially highly skilled and experienced ones, consistently over a long period of time will be a challenge. Maintaining the cost per resource will be a challenge. Economic slowdowns in the West will have adverse effect, as R&D spend is mostly discretionary. All B2B service companies need to have an outstanding relationships and mutual trust with their client. How LTTS manages this over long periods remains to be seen. To summarize, price to free cash flow per share 44, which is okay. Company has paid dividends consistently ever since its inception. Dividend paying companies are great, as they take care of their retail investors and you get some of your money back early. Being a service provider, not much capital is required, hence high interest rates will not have a significant impact compared to manufacturing companies. Compounded annual growth rate for cash flow from operations is 17%, but I would like it to be about 20%. Now you know why we assume growth as 17%. If you are investing in LTTS, track the ROC annually. Should be about 20% consistently, except for a couple of years, which may be exceptions. So to say, if ROC is below 20% consistently over a period of 3 years, perhaps you should reanalyze the investment. Similarly, if CAGR of cash flow from operations for trailing 10 years is below 15% consistently over a period of 3 years, have a rethink. Now coming back to the thumbnail. Engineering R&D services industry is now in a phase similar to that of IT services industry in the early 90s. LTTS is one of the front runners, just like Infosys at that time. If you had invested say rupees 1 lakh in Infosys in 1994 when it went for IPO by 2006 or so, that investment would have become a few crores. But Infosys managed the stock market expectations excellently well over the years. Only time will tell if LTTS manages to do so. Personally, I have placed my bet on the LTTS course. I hope you liked the video. If so, please like, subscribe and press the bell button. These are small things for you but will mean a huge deal for me as I spend days to come up with this video. Also, kindly share it with friends and family, especially those who have not considered investing in the stock market. India is expected to have an incredible growth in the coming decades. Let us do our bit to ensure that as many Indians as possible benefit from this growth. Thank you so much for your time.